For thousands of years, gold has symbolized wealth and safety, but it might not be as safe as you think. The team and I have been tracking gold's performance for years and years, and the figures just do not lie. So in this video today, I'm going to reveal the big misconceptions people have about gold, and I'll also show you some scary figures that will make you think twice before investing in it. But the first thing you need to understand about gold is why people perceive it as valuable, because throughout history, gold has created fear, greed, and panic. From quests in El Dorado to the Californian gold rush, it sparked wars, caused the rise and fall of empires, and led thousands of people to pack up their lives and go searching for it. Now, why is this? Well, it's all about scarcity. All of the gold in the world will fit into just 3.5 Olympic-sized swimming pools, so there's just not very much of it. Now, you might think that this makes it incredibly valuable, and the truth is it does. Indeed, today it's an all-time high as I make this. But it also means that the price of gold is entirely driven by its demand, which can make it extremely unpredictable. So when you actually look into the data, you'll find the price of gold is very, very volatile. Just look at this graph here. You can see that gold is less predictable and it doesn't compare to the returns of the stock market. And this is the first reason that gold is a risky investment. It's just hard to predict how it's going to perform in the future. Gold is a good hedge against inflation. So, to debunk this second myth, let's use an example. If you have £100,000 sitting in your bank account, you're losing around £5,000 a year in your future purchasing power because inflation is eroding the value of that cash. This is the exact opposite of good investing. Good investing is the process of building and preserving your future purchasing power in order to fund the lifestyle and the personal choices that you want. So in theory, it's better to exchange the cash in your bank account for something like gold, which will hold its value and protect you from future inflation. Well, that's the theory, but is that actually true? If you check out gold's performance in the 124 years between 1900 and 2024, the value of gold rose 363.1%, or 2.9% per annum. That's almost exactly identical to the rate of inflation over this period. But if you zoom in on the period between 1980 and 2002, inflation rose by 3.9%, whereas gold lost 85% of its value. And despite recent record highs in gold prices, inflation has also been sky high over the last few years. So how exactly is this good protection against inflation? Well, looking at historical data and comparing expected returns to other investment classes such as real estate, bonds, or stocks, it's just not. That's why we tell our clients that if you have a debt that's due in 1,000 years, then gold's potentially great, because over the long term, its value holds up. But what's the point in holding on to something that may safeguard against inflation centuries after you're gone? In the 21st century, there's no reliable evidence that it will protect you because its price is just so volatile, and your future purchasing power is likely to be better preserved by making other life choices, which I'm going to bring to life for you in a bit. However, one thing that gold does have going for it is its low correlation to stocks. If we had a correlation of 1, it would move in line with stocks. But gold is 0.085, meaning it almost moves in exactly the opposite way. This means that if stocks crash, gold's value isn't affected very much. In fact, the same 2012 study found that 83% of the time that stocks were negative, gold returns were positive. So you could argue that gold is a good investment for diversifying your portfolio. But if you really think about it, just because gold's performance is largely unrelated to stocks, that doesn't necessarily make gold always a good investment. Its performance can still be poor regardless of what's happening in the stock market. And again, if you actually dig into the numbers or the data, it has been. Over the global financial crisis of 2008, gold's price dropped by 30%. So when investors needed it its most, it failed. But even when it has delivered, its performance has generally been fairly weak. In 2022, when stocks and bonds faced double-digit losses, gold didn't really shine. It barely outperformed them, and its value still fell. And in 2008, its value only increased by 5.53%, which might sound good, but actually the US government bonds soared by nearly 14%. So as you can see, gold isn't quite the diversified, foolproof backup plan that people claim. There's next to no data that proves that gold is a diversified safe haven, and that's the third reason it's a risky investment. But besides its volatility, the last point is the main reason that I wouldn't invest in gold. In 2012, the world's gold stock was worth about 9.6 trillion US dollars. And for that amount of money, you could buy all of the cropland in the United States, which is 400 million acres, producing roughly 200 billion annually. And you could also buy 16 ExxonMobils, each one earning $40 billion annually. Still, after buying those assets, you'd have $1 trillion left over. So, a century from now, the cropland will have produced a massive amount of output. Exxon will have produced trillions of dollars in profits for its shareholders, whilst also growing all of its assets. But as Warren Buffett says, you can fondle gold, but it just will not respond. In other words, the gold itself can't grow or produce anything or generate any extra income. Its only value is in its value, which is why he sees no utility in owning it. Gold just sits there. So all you can do if you own gold is hope that the price goes up in the future and that someone will be prepared to buy it from you. And as we've seen, that isn't always guaranteed. Without income, your investment relies completely on future market demand, and this is the reason it makes gold so much riskier than the other asset classes. But the real cost of investing in gold is the lost opportunity cost in your future, which I'm going to bring to life for you now. If you put $100,000 into the global stock market in 1988, by today you'd have roughly $1.778 million, whereas had you put that same $100,000 into gold, you'd be sitting on around $606,000, meaning that you'd have lost out on roughly $1.172 million. Now this really shows why the hype around gold is based upon myth, misconception and cultural bias. But this isn't the only money myth that high earners need to be aware of. There are 5 other incredibly important misconceptions that you should know if you want to protect your wealth. So watch this video next to learn exactly what they are.